Yeah, I think every cycle sort of seems so similar to the last, but then there's deviations and shifts and nuances just enough to like make them maddening every single time. So every single one seems sort of the same, but then every single one seems different at the same time. And as an investor, it just can be so turbulent.
I think the most important thing is to, learn from all of this and figure out like, what are we going to do differently? What are we going to not do anything about? I still think a major skill in this space is to do nothing, like to be patient and just, in my case, it's being long Bitcoin and ETH and trying to not make tragic mistakes doing things with leverage. Welcome to the Edge Podcast. I'm DeFi Dad here with Nomadic. This is our first recording of the new year, 2026. We're excited to be back. We're not going to be doing our usual format where we interview, founders and investors in the space. We wanted to do an episode more on our reflections and impressions of 2025, and then see what lessons we can take into 2026. So, this was a monumental year for crypto. We both believe that we laid the foundation for the industry to be stronger than ever. I'm not sure if the price action matched up to the expectations of what we all wanted to see in a crypto bull cycle, but here we are. Also, if you enjoy this episode, we'd love to get your feedback. This is kind of a new format. We're looking to implement a more market updates-driven type of format for different episodes. So if you enjoy our usual format of interviewing those founders and new protocols, don't worry, we're not going to be shifting away from that. We are very excited to interview the next generation of founders and protocols this year, but we really do want to share more of our candid thoughts and impressions of what we're seeing in the market. Nomadic, do you want to kick us off with some of the points that you noted from 2025?
Yeah, I think every cycle sort of seems so similar to the last, but then there's deviations and shifts and nuances just enough to like make them maddening every single time. So every single one seems sort of the same, but then every single one seems different at the same time. And as an investor, it just can be so turbulent. So one thing that happened this year that, has been talked about a lot is Bitcoin dominance just stayed structurally high almost the whole year. And that sort of feeds into, we never really saw the altcoin rally. Like it never showed up. And I think this is one of the patterns that people were expecting to play out that just never happened. So in typical cycles, we get at top in Bitcoin dominance. I think last cycle, don't quote me, but it was in the 70s, so about 70%, 72, something like that. This cycle we hit 66, but I think we're still at around 58% Bitcoin dominance. So we never got that crash, and Bitcoin just stayed strong pretty much the whole year.
We will talk more about this later in the episode. Bitcoin dominance was on the rise over the last few years, and I think as someone who's not only a Bitcoin holder, but a very vocal ETH holder, and I'm invested in lots of other protocols, this is not what any of us necessarily wanted to see because, we believe that there's other innovations happening in the industry. And so anyways, this has hit me smack in the face over the last few years. And so I'm happy to talk more about this because I think I have, learned through experience, how wrong I was about Bitcoin dominance going up. That said, it doesn't mean all hope is lost for other tokens, but it's important to understand just how much money is flowing into Bitcoin.
Yeah, and to that point, like one of the biggest takeaways from 2025 was just what a banner year for institutional adoption. We had the ETFs kick off, and I think the amount of capital that flowed into the Bitcoin and ETH ETFs, I think surpassed everybody's expectations. I remember we talked to Bitwise in 2024, we were kind of doing their predictions for 2025, and they threw out some numbers that they were anticipating. And basically, the Bitcoin inflows blew past even their most bullish range of predictions. So I think that surprised everybody. Something else that I think surprised a lot of people is we've had these traditional sort of Bitcoin on-chain indicators that have worked for the last 3 cycles. So sure, that's still not a massive sample size, but look, we've had sort of 3 instances where people could look at these on-chain indicators and sort of maybe try to predict what might be happening and when to sell, when to buy, things like that, at least inform your decision. So one interesting thing that didn't happen this time is it appears that none of them worked, or at least they haven't worked in the same time frame that they did previously. I can pull up my screen and just quickly sort of go through a few of these just to show you what I'm talking about.
Before we go any further, let's hear a quick word from our sponsors who make the Edge podcast possible. Sponsors like Toros Finance. Accountable is the new standard for real-time financial verification. In crypto, financial health still runs on screenshots, lagging audits, and blind trust. But Accountable changes that. Powered by the Data Verification Network, it proves assets and liabilities privately across wallets, exchanges, custodians, and banks. Accountable already secures over $2 billion in verified assets across 115 chains and over 90 data sources. To learn more, go to accountable.capital. Grow wealth exponentially. With Toros leveraged tokens, when the market moves in your favor, your gains become parabolic. They're built to ride trends, auto-compounding profits. With Toros, it's simple. Pick a vault, deposit, and your exposure is multiplied, maintained, and protected automatically against liquidations. Toros reduces risk and keeps you in the market ready for the rebound. When markets dip, the vaults auto-adjust, softening losses and preserving your position. Just pick a token to multiply your returns. Toros Finance, exponential gains with leveraged tokens. To learn more, go to toros.finance. Neutral is the next generation of crypto-native yield. Their synthetic dollar NUSD taps into OTC arbitrage, funding rate inefficiencies, and delta-neutral strategies to deliver premium, stable returns without taking market direction risk. Neutral is now officially live to mint NUSD and start earning neutral points. Learn more at neutral.fi. While Nomadic is pulling up that chart, 2 other points to make as it relates to the maturing of the industry, the institutional adoption phase that we seem to be entering. One of those major points that we'll talk more about is the growth of stablecoins. How much more will we grow in the new year? We're at like 300 billion in terms of total stablecoin liquidity. Around 55% of that is on Ethereum. So Ethereum remains a magnet for stablecoin liquidity, and just what does all of that mean for the future? And then we, of course, have to talk about what a banner year it was for regulatory legitimacy.
Stablecoins really have the potential to ensure American dollar dominance internationally, to increase the usage of the U.S. dollar digitally as the world's reserve currency, and in the process create potentially trillions of dollars of demand for U.S. treasuries, which could lower long-term interest rates.
We went from regulation being an existential threat to the industry to now being one of the biggest catalysts for the future growth of digital assets. There's a lot of reasons to be optimistic about, stablecoin growth, but other digital assets as well. And again, what once was our greatest enemy is now our greatest ally, and that's something to be really excited about.
Okay, so I won't spend a ton of time on these. I think just the picture of what you're looking at tells the story, but this is MVRV Z-score. So basically this measures the difference in market cap and realized cap using a standard deviation. So basically what it tells you is how overvalued or how undervalued is Bitcoin at any current time. And you can see just by looking at it, when Bitcoin gets in this green band, it's traditionally been undervalued. That's when the price is low. When Bitcoin gets into this red band, it's typically overvalued, price is high. So what you can see, the last 3 cycles of Bitcoin, we saw this Z-score get into the red band in 2014 and in 2013. We saw it happen in 2017 as well, and we saw it happen in 2021. But what's noticeably different is we didn't get that this time. And And I still don't know what to take away from this yet, but one other one I want to show you is, so this one is the Pi cycle top indicator. And again, I won't get into a huge description of what it is. I just want to show you the image of what happened previously and what didn't happen this time. So this takes the 111-day moving average and the 350-day moving average and tracks them together. And typically, when these two lines meet, we've hit a top. And I think this one has called tops within 3 days historically. So, I mean, this is an indicator that has been pretty reliable the last 3 cycles, but what didn't happen this time is these lines never touched in this 4-year cycle. And then the last one that I've been using all 3 of these in the newsletter that we write. So if you ever want to kind of see more analysis around this, we write these typically around monthly or bi-monthly just to check in and see where things are at. But this one's the everything indicator, and I think this one's pretty interesting because it packs a bunch of things into one indicator. So it takes MBRV Z-score that we looked at earlier. It takes global M2 money supply, takes the Puel multiple, it takes spent output profit ratio, Crosby ratio, and then this active address sentiment indicator, packs it all into a chart, and then similar setup as MVRV Z-score. This is kind of your buy range, this is kind of your sell range. Again, we just got I guess we did kind of hit a bit of a peak here. This was March 2024, but still not to the degree that we've gotten to in previous cycles. One other one I just want to show you real quick. This is from CoinGlass. So this is bull market peak indicators. And this tracks 30 different indicators. And again, traditionally, a lot of these hit in previous cycles. So of these 30, if you can see up here, 0 have hit this cycle. And it's like, this is still telling you to hold, obviously. But again, I don't know if all of these are broken, these don't matter anymore. The takeaway is Bitcoin has changed dramatically this year, especially with the ETFs. I'm curious, what you make of this. I mean, we've had these indicators that have worked previously, and then all of them have completely whiffed. So for me, this either means they're broken, they don't work anymore. Maybe the cycle is being elongated, like some people are saying. I just don't know what to make of it or what to take away from it.
So these are indicators that obviously you and I talk quite a bit about. And yeah, I was hoping that at least a few of them would hit. And I do think at some point there's a really simple indicator that we talk about where Coinbase becomes the number one app in the App Store, or maybe it was this cycle we talked about the fact that Phantom at one point had moved up really high into the rankings there. I think Coinbase was number one, but it was strictly under the financial apps. I'm not sure if it was the true number one finance application. Again, these are just a part of the story, but you look at these and you're looking for what? Pattern recognition. You're looking for signal that things that you've experienced and seen in prior cycles are happening again. Despite all of this, with this talk of signals, I think we have also debated that there was euphoric signal in the past few years with meme coins. There were just silly returns that people would see from, absolutely, call them dog shit, worthless types of projects, but they were betting on them because they were betting on the fact that other people were going to bet on them. And some of those did cross the chasm, I think, and become, call it a blue chip meme coin. But most of them ended up being, a short-term burst of attention and then ultimately died a slow death. And I think that, we're trying to reconcile with what has changed this cycle. I really love the way that Ben Cowan articulates it. And this is one of my points taken from 2025 is that he has, shared that he thinks the cycle topped on apathy, and he's been drawing a parallel to 2019. I'm not sure if I, believe that what we're living through is a mirror of what we would have experienced in 2019, which was really like in the heart of a major bear market, but there was a bullish uptrend at some point. And the idea to take from all of that is that if we topped on apathy, if all of these signals didn't fire off, is it possible then, if the euphoric retail mania never came back, there should be less sellers to capitulate? And the question is can we see a drawdown in this midterm year? You know, if we're going back to the Bitcoin 4-year halving cycle, we topped in Q3, Q4 of the post-halving year. Now that we're into this midterm year, which has historically been 2018, 2022 style bear market drawdowns, is it possible that we don't draw down as much? And I don't think it's hope for me. I think we've talked through what we're seeing here and thought, okay, well, the bull run wasn't as enjoyable to the upside. We didn't have as much of a rise in price for most assets, but even Bitcoin. I think the returns on Bitcoin are still impressive, but you know, they left something to be desired. I think ETH is another one. Like, some people might not have been aware that we did hit a new high on ETH in August 2025. That said, it left something to be desired. So is it possible that we won't have the same source of sellers in 2026 here? So yeah, I take a lot from the signals you're talking through.
Yeah, and one thing that you mentioned there, looking forward to this year, you said something like, is it possible we don't have as big of a drawdown? And I think, yeah, that's possible. And what I think is also possible is we don't have a drawdown. And this could be a bull year for Bitcoin and for the asset class. So again, that would be implying that the traditional 4-year cycle is breaking rather than we've just mirrored it. So you know what? I don't know. We're going to find out though in 2026. So the one other thing I kind of had for 2025 before we get into the 2026 stuff is, you know, despite some horrible lessons that were learned in DeFi, talking about stream finance, talking about some of the implications of October 10th, I think DeFi once again de-risked itself by, again, a painful lesson. And I don't know how long this will last. I hope this is the new norm, but we've also seen transparency start to be valued in DeFi again, and revenues kind of taking the forefront. Again, we'll talk about that specific point a bit in the 2026 stuff, but my sort of one-liner for this year was 2025 wasn't really a hype cycle. It felt more like a maturation cycle, like we all had to take some medicine. And this is a necessary sort of clearing out that needed to happen and maybe is still going to be ongoing in 2026. But yeah, that was kind of my takeaway.
Yeah, if this was a year of growing up, there's lots of proof to how we grew up. One of those we've covered on the podcast with Robinhood's Ethereum Layer 2. There was always a talking point around a profitable business that could be run through an Ethereum Layer 2, that the customizability of those Layer 2s would be appealing to folks who want to build their business on-chain, especially traditional finance players who call them like major fintechs like Coinbase and Robinhood. And so that's been extremely promising, but it's still early, especially for someone like Robinhood. Robinhood has 1,000+ tokenized stocks trading on chain. Meanwhile, I think Base is the second largest layer 2 for Ethereum. I need to double check this while we're live here. I'm going to check the DeFi Llama chains chart here, and yeah, let's see. Number one is Base. Okay, yeah, Base is number one. Yeah, in terms of just, this is TVL. So Base has 4.76 billion, and Arbitrum, being in second place, has 3 billion. So anyways, impressive numbers. And Coinbase has a head start. Coinbase has, they've been able to build new products for their customers that are DeFi native, that draw from what DeFi does best, but then they've abstracted away all the complexity. This is another episode we covered in 2025 with ETH-backed loans, as well as Bitcoin-backed loans, CBBTC on Base. So the takeaway from all that is that there's just a lot of promise for more businesses to come on chain and for the industry to grow with all of this liquidity and business activity coming on chain, building their own Ethereum layer 2 or building a new business on someone else's layer 2. We talked a little bit earlier about stablecoins. Again, I think there's more to cover there. And then probably the final point here I'd like to flesh out a bit more is one of the headline stories in 2025 is a resurgence in sentiment for Ethereum and ETH, the asset. As a longtime ETH holder, I think the spring was one of the scariest, most painful moments. ETH reached a low of, I believe, $1,400. You're now talking about a price that was achieved in 2018. It was a terrible story to tell, but happy to say, for a number of reasons we'll talk about here, why we bounced back and why we're now in a totally different reality with ETH, and the bid for ETH has grown substantially with institutions and digital asset treasuries bidding it. So anyways, which of the points would you like to cover first, Nomadic? I feel like we need to talk more about just the lesson from all of this. So we've got a lot to take from 2025, but I think the most important thing is to, learn from all of this and figure out, what are we going to do differently? What are we going to not do anything about? I still think a major skill in this space is to do nothing, to be patient and just, in my case, it's being long Bitcoin and ETH and trying to not make tragic mistakes doing things with leverage. The Mantle Global Hackathon is a 3-month competition inviting developers and founders to design and deploy scalable Web3 and RWA products on Mantle's modular Ethereum L2, built for high performance, low fees, and full EVM compatibility. With $150,000 in prizes and a $30,000 grand prize, now is the time to build. Register by December 31st, 2025. Submissions are due by January 15th, 2026. To learn more, go to mantle.to/hackathon/U4U, and don't forget to follow Mantle_official on X.
Katana is an opinionated blockchain. Its opinion is that for DeFi adoption, there are 2 key things we need: deep liquidity and high yield.
To learn more, go to katana.network. Decibel is the new sound of trading, a fully on-chain trading engine supporting spot markets, perps, and yield to trade global markets. Enjoy trustless execution and sub-penny transaction fees. Join the future of trading at decibel.trade and access the Decibel testnet today.
Yeah, honestly, you kind of nailed it. And I think what a lot of people realized is there's a very small list of assets that you can and maybe should hold. And I think that list got even shorter for me this year. And, you and I talk all the time together, kind of offline on the podcast, and we're sharing notes on things. And yeah, that the list is just extremely strong, because I think the market is finally realizing you need to prove reasons why users should hold you. And I think we're seeing a lot of important things happening for token holder rights and transparency for token holders. So another thing that happened near the end of 2025 and throughout 2025 really was this back and forth with, or this internal discussion between Aave Labs and the DAO, and just where value is accruing for token holders versus where value goes to for the labs entity. And I think we're actually getting to a point where, as much as that was like a painful discussion, I'm sure for those parties involved, it needed to happen and needed to happen in the open, and it's just going to push the space into even better territory. And then the other thing you're seeing is protocols are now doing a lot more of these like year-end or even quarterly sort of investor relations calls with their token holders. We need to see more of that. These assets need to be treated and respected if you want people to hold them. And I think, again, this just goes back to that maturation cycle. This is what 2025 has felt like to me. But
that's funny. I wasn't even thinking about that. This is this is a great point to take from 2025. The unification proposal that Hayden Adams put forth, the fact that we've moved from an old world where foundations basically did everything that the lawyers told them to do to ensure that they were never deemed a security, issue these tokens that are nothing more than governance tokens. They have no other real rights to the labs entities. In most cases, they earned no fees. We are finally moving beyond that. And not to not acknowledge like the brave few who did push for that. Many times those were anonymous founders. On rare occasion, you did have doxed founders who were, being that bold. But Gary Gensler and his goons, they incentivized those folks, founders, to have to act in this manner to like basically not create the token structure, the token design that they wanted. And meanwhile, investors got very vocal about this, and Uniswap has been at the center of all of this. They are a flagship DeFi protocol. They're a pioneer. They're a trailblazer. We are so grateful for like all the fighting that team did in court with, Gary Gensler and his team. The nut job Amanda Fisher, who's now at Better Markets, another person who held us back. These people were hell-bent on killing the industry, and it's because of folks like Uniswap and, of course, Coinbase and Kraken and Gemini and all sorts of other players who fought on behalf of the industry. So it kind of all plays into the regulatory talking points, like the fact that we're now looking at regulation because of the Genius Act offering clarity for what is a compliant stablecoin, and now we're looking to the Clarity Act to expand on clarity around regulating other digital assets. So we've come very far in just a year's time, and I think this is really important for us to get to a place where DeFi can finally rewire the back end of TradFi. There's a lot of TradFi that wanted to adopt DeFi, I'm sure, earlier than this, but there was too much risk in getting involved. And anyways, the unification whole saga that's happened, what's been going on with the Aave debate, these are really important conversations to happen to move the industry forward. And obviously having respected notable founders like Hayden from Uniswap and Astani from Aave, like no better people to be having those conversations out in the public and helping to push us forward.
I don't even know what we're calling these. I don't know if they're predictions or more just like a 2026 thesis. I don't know what you call this, but this is kind of like the patterns that I see happening in 2026. That's kind of the perspective I'm coming at this from. I'll start out, but the first one is Bitcoin just becomes even more financial infrastructure. It becomes more usable. This is one thing I really want to see happen further. So it's been happening, but this is just literally just scratched the surface of where this can go. And I'll give you a few examples. So on chain, Bitcoin is used heavily as a collateral asset. We see this on Aave. We see this on all the major borrow lend platforms. And what that starts to make it is it's not just an asset that you trade. It makes it more of a sticky asset that you hold. When you start borrowing against collaterals like Bitcoin and ETH, it just makes them stickier. So if you take that one rung up on the ladder, what is Coinbase doing? Coinbase is doing Bitcoin-backed loans and ETH-backed loans. Currently, they've originated $1 billion in loans from this program. This is huge, again, because I think it rewires people's brains as, hey, this isn't just an asset I trade. This is an asset that has value, and it's a collateral asset that I care about. I'm going to borrow from it. just like, how people take lines of credit from their homes. I mean, homes are already illiquid, but I think once you start doing that, that asset becomes stickier. Again, it's not something that you move in and out of as much. And then now we're seeing this, if you go even a ladder up, we're seeing this with things like iBit. So major brokers are allowing people to use this as margin collateral. I think the more this proliferates, the more Bitcoin becomes a usable institutional asset. And this is just something I'm, really hoping we see more of just heading into 2026. So yeah, and just even more usage of Bitcoin as tapping into existing credit rails. So things that you can do with Bitcoin that, haven't really been thought of or done as much in the past, especially by people that aren't as native to crypto. So yeah, I think there's a massive audience that we're just opening up to.
Yeah, we did an interview in the fall with Sid Ramesh, who leads the crypto lending products, I think, at Coinbase. I can't remember his exact title. But anyways, Sid's a longtime DeFi native investor and user, and one of the best people we could have had, go work at Coinbase. And so you have this product now available where anyone can basically borrow against their Bitcoin liquidity instantly. No applications, no credit score report, none of that hell that you have to go through in the traditional world. And yeah, I mean, an important part of this story is just that there's so much liquidity in Bitcoin because it's a multi-trillion-dollar asset. The second closest thing at this point is ETH, which I think on any given day is 300 to 500 billion in market cap. And with all that liquidity, folks that are holding that don't want to sell it. They want to be able to borrow against it. And so now you have the floodgates opening with folks being able to borrow on something like Coinbase. That's totally like a retail-driven element. When you think about the major Bitcoin holdings, though, with sovereign wealth funds and institutional type investors, maybe they're not going to be using like the Coinbase front end, but they want to be able to borrow against that as well, I'm sure. They want to be able to, put that liquidity to some use aside from holding it as a store of value. And yeah, Bitcoin just continues to be this flagship, digital asset, being the number one crypto asset in the world. So yeah, big year for Bitcoin going even more mainstream than it had prior to this.
All right, what do you got? Let's go to one of yours for 2026.
2025 was defined by the rise of stablecoins. Part of it we covered earlier. It was the Genius Act. The Genius Act was huge because it provided clarity around what is a compliant stablecoin. That opens the floodgates for that many more stablecoin issuers. It also means that traditional finance can now safely get involved in DeFi, that it's no longer this toxic asset class. There's not this risk that they're going to get a knock at the door from the SEC for, trying to get involved with DeFi. So huge watershed moment. I believe liquidity grew from around 200 billion to 300 billion in terms of total stablecoin liquidity. Around 54 to 55% of that is on just Ethereum mainnet. This is a part of like my lesson for 2026 is that I do believe that stablecoin liquidity continues to march upwards. Easily could reach 1 to 1.5 trillion. 1.5 trillion was actually one of the predictions Etherealize just published in one of their reports. But a part of this is stablecoins are, as Tom Lee put it, the chat GPT moment for Ethereum, for crypto. The folks that are putting stablecoins to work, there's a large participation that's derived from institutional type investors. Those folks cannot afford a mishap with a network going down. And so there's a reason that Ethereum continues to be a magnet for stablecoin liquidity. It's the security of the network. It's the track record with uptime it's the track record with 10-year uptime. And then again, there's this sort of like credibility brand that it has for working with, folks like BlackRock, and we've got JP Morgan on board, and you've got, they've got a tokenized money market fund. We've got Robinhood that's now building a layer 2. We've got Coinbase. This is an easy, defensible decision, I think, for them to put liquidity on Ethereum. And so I think the gap between Ethereum and other chains will continue to widen. I think that as more and more, trillions of stablecoins moves on chain, you're going to see more money moving onto Ethereum. And, I think as layer 2s continue to prove themselves because of the security they inherit from Ethereum, we're going to see a lot of growth there. And then we will also, of course, see, I think, a rising tide lift the most premier boats in terms of L1s that are hosting stablecoins. Solana is clearly a major blockchain for hosting stablecoins, and we've got others that are in the mix there. So, anyways, 2025 major year for stablecoins. That growth, I believe, continues regardless of whether or not this is a down year for crypto. And I think that the biggest winner in 2026 will continue to be Ethereum from a stablecoin liquidity growth standpoint. Anything there you disagree with, Nomadic, or anything else to add? One
thing I would add is I want to see what happens with the volumes as well. So not just, static, okay, where are stablecoins sitting, but what's happening with the volumes. And what I mean by that is, how much of these volumes are being used for things like payments and transfers versus DEX trading or trading. I think it's funny because, whenever, we try and show something like, hey, look at all this on-chain volume with stablecoins, there's people that are quick to just say, well, yeah, a lot of that's trading. So we're going to throw out a lot of that. But I want to see this like payment and transfer segment grow and just see how that proliferates in 2026. I think it's going to grow substantially in 2026 is my prediction. So I think that'll be an interesting one to watch as well.
Yeah, this is a part of the story I think I've left out. It's not about us just holding stable coins in a wallet and paying each other and transferring between accounts on Ethereum or any other chain. It's about that as a unit of account in DeFi. So we've got yield to be earned, we've got credit markets to lend to, we've got tokenized treasuries on chain. Sometimes we use stable coins as a form of collateral in perps and exchanges. We want to access exposure to real world assets on chain. There's this rich DeFi economy that is underpinned by the use of stable coins. And so I think any chain, any layer 2 that is attracting that liquidity, they're going to see a rise in fees. They're going to see the growth of a rich DeFi economy. This plays into validator rewards depending on the network. And, liquidity begets liquidity. If we have that much more stablecoin liquidity on a chain like Ethereum, DeFi builders and new TradFi players that are coming on chain, they see that as liquidity to take advantage of, to be able to, access and to be able to grow their own business or protocol. So this is a huge part of the story. Like, it's very, very important to understand that it's not just about number go up with these stable coins. Those stable coins are driving the growth of DeFi, across the landscape. And this ultimately is going to be seen in the growth of fees and protocol revenues.
Actually, that's a really good segue for my next one. You're talking about fees and protocol revenues. That's like my next one for 2026. Again, this is a pattern we saw in 2025, but I think it just compounds in 2026. So I think we've always, early DeFi has just felt like these science experiments and kind of this toy era, but I think DeFi is now being valued more like businesses. I'm talking specifically the apps built on these networks, not necessarily the networks, but I think this is just a trend that evolves in 2026, and it's such a welcome trend. So I think revenue is just going to start mattering a lot more than TVL. And I think the way people collectively analyze all of these tokens in this space is changing and changing for the better. And that's part of the reason why, at the outset of this conversation, I said my basket of things that I'm willing to hold is very small, because I've kind of always been this fundamentals-driven investor in this space. And that's been very hard to navigate at times, because all these new shiny objects popping off, and you want to chase this and you want to chase that. And there's so much mimetic energy, and it's so easy to kind of lose your way in that crazy storm. But really, these are the things that I've been tracking the whole time I've been in DeFi, is like fundamentals, revenues. I want to call out an amazing piece written by Patrick Scott. I can't remember the name of it. We'll flash it up on the screen, but it's incredible. He basically walks through DeFi Lemma and just shows you all the metrics he's been kind of looking at and aggregating over his years in the space. And honestly, I think if you use this, you'll just hone in on a really good collection of assets. So again, this is something that I hope is a trend and not just, a flash in the pan, that the space is collectively looking at revenues and organic revenues, not, hey, we're going to throw a ton of incentives to generate some revenue for a brief period of time. But yeah, more long-lasting, usable protocols that matter. And again, the result of this is valuations for a lot of things are going to go down.
As a DeFi investor, I turn to Maple for permissionless institutional quality yield in a single liquid asset backed by over-collateralized loans. Maple's Syrup USDC and Syrup USDT are now supported as collateral for enhanced yields on major DeFi liquidity hubs such as Pendle, Fluid, Camino, Jupiter, Morpho, and Aave. To learn more about Maple, go to maple.finance. Hey folks, I want to tell you about our sponsor Gearbox, the protocol that reimagines on-chain lending. With Gearbox, you can access 10x credit across DeFi or lend for passive yields with single asset deposits and no impermanent loss. Users can access leverage to margin trade, stake, farm, and more. To learn more about Gearbox, go to gearbox.fi. Puffer Institutional delivers secure, high-yield Ethereum staking built for institutions. With battle-tested security, granular access controls, and the ability to boost APY by securing multiple AVSs, Puffer gives institutions full control and optimized returns. Puffer is also behind the Unify-based rollup, aiming to transform Ethereum's future in a world where all L2s are working together. To learn more, go to institutional.puffer.fi. I think we covered a lot of ground across these different topics so far in terms of regulation now being a catalyst for the industry. I just want to reemphasize that the Genius Act was the big win in 2025. I was looking, for what are the main takeaways from the Genius Act. And so a few of those bullet points are, it requires stablecoins to have one-to-one reserves, quote-unquote transparency and audits, quote-unquote redemption rights, and then they also define different types of issuer categories. So anyways, this has led to clarity on how you can ultimately issue a compliant stablecoin. I think it's huge for stablecoin liquidity to grow. And if we buy into the idea that this is one of the most important primitives in DeFi, it's important for transacting and accessing all the yield and the different types of finance applications, then you can see the demand for using DeFi growing, and you can see the demand for stablecoins, of course, being like the start of all of that. The thing that I wanted to really reemphasize, though, is in 2026, we have this Clarity Act that will hopefully get approved. And the Clarity Act is really important for the rest of digital assets. So we've got this clarity around stablecoins, but we need that for digital assets. Some of the context to that is that just for years, we lived in this like legal gray zone. And that was, thanks in part to Gary Gensler and his goons. I'll continue to call him Gary Gensler and his goons because that's what they were. And those folks left us in a place where I think essentially teams that went in and asked for clarity were told to look at, the existing laws and to, fit a square peg into a round hole. But by the way, if you screw up, we'll be knocking at your door. So of course, it was a reason for many folks to not get involved in our industry. And so the Clarity Act will be a huge win. It should be another watershed moment for the industry, despite the fact that, again, 2026 from a 4-year Bitcoin halving cycle is historically set up to be a down year, or at least a year where we see a lot of drawdown. Could be an amazing buying opportunity, of course. I think that's how I flip it on its head. This is going to be the first year in a few where I am, really geared up and excited to be able to potentially buy the assets that I hold at, more reasonable values. So anyways, if we get this Clarity Act, I think that it could be setting us up for a foundation of more growth in the future. I'm not quite sure if it would be like a catalyst for price action. Maybe, we see some uptick in prices in crypto because of the Clarity Act. But if you are a long-term investor in this space and you're looking out just a few years, I think that this is really, really important that this gets passed. So anyways, that's another sort of lesson that I'm taking into 2026.
Yeah, nothing to add on that one. I think you're probably tracking that a bit closer than I am. But yeah, I might hop over to another one. I think I'm going to kind of merge two together here. So one thing, again, everybody's talking about tokenization and stablecoins in 2025. So it's no surprise that I think tokenization is going to go crazy in 2026. But even though there's been a material amount for the on-chain world of tokenized assets coming on-chain, it's still barely a drop in the bucket for what exists out there, obviously, in TradFi, what can come on-chain. And to me, these are still experiments. They're a lot of these big players are, kind of poking the tires on, hey, did this work? Is this working? And I think a lot of feedback that they're getting from these experiments is, yes, it is working. And hey, we're able to do basically make our whole organization more efficient by doing things like this. So one area where I think this is going to show up, and I've seen a lot of people talking about this, and I think it seems like more of an obscure thing, but I think RWA looping is going to be really big. There's a number of teams kind of working towards this. There's, Camino, there's Gearbox, there's 3F Labs, which is a team that both DeFi Dad and I have invested in. But I think it solves a real world problem that TradFi can't really emulate. And I think whenever there's a situation like that, that's like an edge. And I think the yields that are going to be generated from this are going to be pretty massive. So there's a bunch of sort of sticking points that make RWA looping difficult to do right now. But again, some of those teams that I mentioned are tackling these problems. And what I think you're going to get is just amazing UI, UX, and high yields on, tokenized funds, different types of RWAs, different types of private credit funds. And I think this is just going to be something that plays out big time in 2026. The other aspect, of course, to tokenization is we've had, stocks being traded on chain, and this has opened up 24/7, 365 trading and access for people globally, which is huge because people that even couldn't trade the S&P 500 can now access it from anywhere in the world and trade it 24/7. We're already seeing this kind of emerged in the on-chain world, but we're seeing Coinbase be like, okay, we need to do this as well. And now you're seeing even bigger exchanges like TradFi exchanges realizing that they need to do this too. So what's happened is the Overton window has been shifted on this, and it's making TradFi realize they need to offer this and be competitive with this. So honestly, I think the whole fabric of trading is changing in 2026, and we're going to move to a more, like I said, 24/7 365 world of trading, for better or for worse. I mean, I think it was probably good that people got outside on weekends and evenings and, didn't have bloodshot red eyes all hours of the day, but it's happening.
The most important episode to go back to on this topic is with 3F Labs and Gearbox. This already exists. Like, there's huge demand to be able to loop RWAs. Now, the number one RWA is tokenized cash. So, a stable coin or a tokenized stable coin where the underlying is being put into T-bills, there is some sort of a yield there then, like 3 or 4%, let's say. And the question is, can you potentially borrow at a lower rate there? Where we saw an explosion, though, of this demand for RWA looping, unfortunately, was the lead up to stream finance blowing up. And, I think whatever pain we felt as an industry from stream and a few others blowing up was timely, just because to have hundreds of millions of dollars wiped out, or maybe it was even as much as $1 billion, I'm not quite sure, that allows us to have a reset and to move forward. And, we just did a podcast recently on Accountable. They have real-time financial verification as a data verification network. The idea is that you can verify, is a stablecoin over collateralized or not? Or in the future, I would imagine we'll see instances where you can verify a private credit asset is over under collateralized, or where the money is, or where the reserves are. These are questions that somewhat got answered like this past year, but unfortunately there's a mix of lots of like screenshots being thrown up on websites as financial reporting, and there's delayed audits. There's in some cases just fraud happening and people are lying about what's there, or there's just a vacuum of information. Like, we just don't know where the reserves are for certain private credit vehicles on chain. So anyways, Midas has been a big part of this, I think, in a positive way, bringing money on chain and having, liquid funds run strategies and folks being able to buy into that. There was a lot of demand for Pendle to be able to access fixed yield versions of those Midas funds. And then we have, in terms of true RWA looping, we've got something like Gearbox where we're able to, put up a Midas token and then ultimately borrow from Gearbox and loop up, in some cases, 10 to 12x. So, the key here is, are protocols ready to enable and host more RWA looping? Absolutely. Is there the liquidity out there that's willing to lend to it? Absolutely. Are there enough blue chip RWA opportunities? Probably not. I don't think there's enough of that yet. And again, my focus has been more on what people called yield-bearing stablecoins, but in many cases they were like private credit funds that were earning yield on and off chain with those yields. Actually, I'll leave off with this. I think like the ultimate proof of demand for this is Athena. Athena has a programmatic basis trade that is tokenized. That trade is not easy to pull off. Most of us wouldn't be able to pull that off. They've done an incredible job of scaling that. That said, folks that are buying and holding SUSDE, staked USDE, when they're earning with that basis trade, if that basis trade, is upwards of 10%, which it has been over the last few years, now it's, I think, down closer to like 3 to 4%, closer to T-bill yield. That has been the source of yield you need to be able to go and loop, because there was lots of opportunity then to borrow stable coins at well below 10%, some cases 3, 4, 5%. So that's the perfect setup for it. So RWA looping is, going to be huge, but we really need to do some work in terms of the way that RWAs are issued. I think there's a lot of pain ahead for folks that don't understand in certain cases that they might not have any real rights to the underlying with an RWA, and they're gonna buy it like like they're buying a stock on Robinhood. And, truth is again, some of these are really not going to afford the protections to the holder that person is hoping to have there. So
what do you got next? Do you have any more?
I do. I think I have one more point I want to make. I think we've covered a lot here. One of my major takeaways from 2025 is the resurgence of the sentiment around ETH, the asset, and Ethereum. Ethereum, the network, has proven that so much is going to be built on it. So the EVM has been thriving, but there's been this talking point of, if Ethereum, the network, does well, does ETH, the asset, ever actually do well? And I'm not here to talk as much about that connect or disconnect that people see. It's more around just the sentiment and the price and the signal that we've seen. I think the first half of 2025 might be one of the worst 6-month periods for us in Ethereum. I mean, despite everything that is dependent and reliant on Ethereum, 2018 to me was much darker because there was nothing essentially built. But the first half of this year just was painful because it felt like everyone was just beating up on ETH, the asset. And what that ultimately led to is what's important. We saw the price of ETH draw down to $1,400. $1,400 is the high of the 2017-2018 cycle. So it was just an awful story to tell. And we were doing podcasts at that time, talking about how mispriced ETH was. We had Ryan Berkman's on, a few other guests at the time, Etherealized. Those are great podcasts to go back to. I think everything that we talked about, that Ryan and Danny Ryan and Vivek talked about, a lot of that is played out this year in terms of the repricing of ETH, but we still have a long way to go. A few of the highlights in terms of the turnaround. So if the first half sucked, the second half of 2025 was equally fantastic then. We saw the BlackRock ETH-A ETF become one of the fastest ETFs in history to reach 10 billion in AUM. I think it was the third fastest. We had corporate treasuries start to buy into ETH, most notably ETH-denominated digital asset treasuries. So that was the big story of the summer. I think Tom Lee is like Ethereum Jesus. He basically put the industry on his back, went into the mainstream news and told stories about ETH and Ethereum and dumbed it down for investors like no one ever had done before. And so ultimately, 4.77 million ETH was bought in under 12 months. That represents around 4% of the total ETH supply. At one point, over 1.7 billion ETH was purchased in a single week. So we just had this amazing summer. And we've still got lots of optimism here in 2026, despite the, whatever part of the 4-year halving cycle we're still going to be reliant on. Someone like a BitMine has publicly stated that they are looking to acquire up to 5% of the total ETH supply, and they currently have bought up / control just over 3%. So there's a lot more buying to happen there. There's other ETH treasuries, like SharpLink and BTCS and all sorts of other folks. So we've got a huge bid there for ETH, the asset. We also have U.S. retirement accounts. I think that U.S. retirement accounts hold something like 44 to 47 trillion. I was trying to figure it out this morning. But my point is that at one point in time, I think it's the Department of Labor had guidance that basically told financial advisors to not advise their clients to have crypto exposure. That guidance has been rescinded. And so now that opens the floodgates to financial advisors who have a fiduciary duty to act in the best interest of their clients to be advising them to have some exposure to this industry. And the two spot ETFs that have the most demand and the most amount of assets under management is Bitcoin and ETH. So I expect that the passive buying that happens in those retirement accounts to the tune of, potentially trillions. I don't know if we're going to see trillions in 2026, but over the long run, trillions will be buying ETH in U.S. retirement accounts, and that has to be priced into the asset. So we've got, the rise of stablecoins we've talked about. We've got these U.S. retirement accounts. We've got ETH treasury companies that are buying up ETH. And we've, of course, got all the demand for ETH to be able to, build on L2s to ultimately earn that ETH native yield on chain. There's just a lot going on here. So the tailwind for ETH going into 2026 is all of that. And I do think that ETH, the asset, has finally crossed the chasm to proving itself as the number 2 crypto asset in the world. And, it's questionable, could it become number 1 over time? I'm personally not worried about it. I think that Bitcoin and ETH as digital stores of value have so much room to grow. And the best thing in the world is that if you buy into the digital gold narrative with Bitcoin and maybe a digital gold slash digital oil narrative with ETH, you've got gold itself and metals that have been having the best year ever. I think gold was the best performing asset of 2025. So historically, I think we've seen Bitcoin and then I guess ETH and the rest of digital assets play catch up with gold. That in certain instances, ETH acts like a digital gold, but in other instances, it acts a bit as almost it looks a bit like a tech stock and can obviously go up during good times, but also play catch up with gold in bad times.
I was gonna maybe add, for just valuing ETH, the asset, you should go back to the podcast we did with William Mugayar. He's got a great paper that he wrote recently. I think it's called, what the heck is it called? Ethereum's Blueprint, or it's called The Internet's Blueprint for Ethereum.
Yeah, The Internet's Blueprint for Ethereum, $1 trillion public goods valuation framework. He has created a framework to show how Ethereum is like the internet in terms of it being a public good. And he does a great job in the podcast of teaching us about all the mistakes that were made in the early days of the internet and trying to value internet-based companies and internet infrastructure. And I think the main takeaway was they horribly underestimated and mispriced it. Even with the bubble that happened in the early 2000s, they still terribly mispriced how much all of this would be worth in the future. And I think it's a great framework for trying to value something like Ethereum that is not a publicly traded company. It's not a company. It's not a for-profit company. It is a public good. So anyways, check that out. Check it out in our Spotify library.
Yeah, I have one last one before we go. And I think it can sometimes be important to look at mini bubbles that happened in years past to see what could happen going forward. So one mini bubble was the whole agentic or agent meta that played out in crypto. And I think those can be, a sign of maybe things to come, or sometimes they can just be a flash in the pan and it's going to go nowhere. I think what we saw play out earlier was a sign of things to come. And I think the agentic finance era is going to be really interesting. So all of the big players, like Anthropic, OpenAI, Microsoft, whoever, they're all getting into this agentic space. And I think, once these agents get on-chain rails behind them, I just think we're just going to see a ton of non-human DeFi and on-chain interaction happening. So one of the catalysts for this is, I think we all kind of collectively learned about this obscure term X402 in 2025, but what the hell does that mean? Basically, it allows machines or agents or software to interact with websites and pay for things essentially, or use data or something like that. But what we didn't have before was these agents would be, scouring the internet, and they'd keep getting blocked and they couldn't do things. So I just think the ground is really set for agents being able to do end-to-end tasks without humans in the loop. Again, that's like a weird future. Again, I don't know if it's good or bad, but what that it just enables is just the proliferation of a lot more, I think, on-chain activity and just, website activity happening with agents. So again, they'll just be able to do things sort of uninhibited by us and a lot more automated than even we've had before. So that's something in 2026 that I think will go nuts at some point, to be honest. I think it's kind of ready to go.
Yeah, I don't think I have much to add there. I just buy into this idea that agents will continue to grow. Agents are users. We have always talked about onboarding more users on chain, but that's always had a limitation of like what humans could we attract and convince to come on chain. And so when you have agents that are ultimately able to transact, I think it's hard to really comprehend how big that's going to get. I think this is something for me, even though I buy into what you're saying, I think I'm underestimating the agentic activity of the future. And to be honest, it kind of scares me too. I think that there's, just concerns about like, when do the agents completely take over in terms of trading activity, and basically where do you find your edge to be able to invest and trade if you're trading against 24/7 bots that are, super intelligent and able to, do things a lot better than I'm sure we would be able to do. But I think this is probably a great place for us to wrap up. We don't really need to share any guest information like we normally do. Just a reminder, of course, you can follow me at DeFi_Dad. Nomadic, remind us of what's your Twitter handle?
Yeah, it's at Nomadic Cap.
Just a quick disclaimer. This podcast reminder is for informational purposes only. It should not be relied upon as a basis for investment decisions. You should do your own research. This is not a recommendation or endorsement to buy any tokens or bet on any related platforms that we discussed. We are super excited for 2026. We would love your feedback on the episode. And then one last reminder, we referenced a bunch of different podcasts. If you just subscribe at the-edge.xyz or just, go into one of our channels, you can find all of those different podcast episodes. We'll do our best, though, to put these into the show notes so you can easily find them. Thanks, everyone, for tuning in. To stay up to date with future episodes, plus get expert tips, strategies, and exclusive content, subscribe to our free newsletter at the-edge.xyz.